Good morning. This is Andy Cates from the Global Economics Department at UBS. Notwithstanding the welcome degree of policy cohesion over the past few days and the big capital injections that have occurred, the relief rallies in markets appear to have now faded. The U.S. equity market gave up most of its gains that it recorded in the morning session as the focus switched from banking relief to the outlook for earnings. Asia's markets, meanwhile, have followed that lead and have, on the whole, tracked lower throughout the day. What must surely be happening here is that many in the market are realizing that the global economic scenario that confronts us is fairly bleak. Further declines in house prices, a further retreat in profits, and a rise in unemployment are all a pretty lethal cocktail for the world economy in the period ahead, and one that will almost certainly drive default rates up and challenge the rosy scenario that's still built into analysts' earnings estimates. It's true that valuations suggest that much of this has been discounted, but that doesn't mean, in our view, that investors should suddenly start discounting a more upbeat scenario in the period ahead. As illustration of the challenging global economic environment we now confront, we've seen Posco, Asia's third largest steelmaker, warn that demand will fall in the current quarter, and that in turn helps lead the commodity complex lower overnight. We saw a 5-point plunge in the latest weekly ABC estimate of U.S. consumer confidence overnight, along with a retreat to a 6-year low in Australia's leading index. And the Fed's Yellen has chipped in as well with suggestions that the U.S. economy already appears to be in recession, even though, along with her colleague Bullard, she acknowledges that while rate cuts can help, they're not necessarily a panacea. Mr. Bernanke speaks about the U.S. economy later today, though his speech will probably be identical to the one that he delivered last week. As a student of previous banking crises, Mr. Bernanke knows that economies do not typically fare well in the aftermath of a full-blown crisis. He also knows that a lot of spare capacity opens up, rendering a great deal of downward pressure on inflation. And he knows from the lessons of history that the demand and inflation environment are typically much more important for the path of government bond yields than, for example, supply-related dynamics concerning government debt and deficits. Ahead of his speech, we get a glimpse of the U.S. economy's consumer spending momentum and inflationary pressures as we headed into the crisis via the September estimate of retail sales and producer prices. The October Empire State Index of Manufacturing and the Beige Book are also, for the record, slated for release. The focus for markets here will probably be retail sales, which we think will have remained on the back foot, and almost certainly suggests that consumer spending has notched up its first negative quarter since the consumer-led recession of the early 1990s. And this consumer weakness, of course, has unfolded even before the full-blown financial crisis erupted over the past 2 weeks. Other data on the economic front to keep an eye out for today include the final September inflation estimates in the Eurozone, along with the latest labour market stats from the UK. These, again, though, are fairly backward-looking, and deviations from consensus might not render any major market reaction. That's all for today. Thanks.